Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Andrew Mitchell from Ophir Asset Management. Andrew is going to be talking to us about how he's currently viewing markets and some of the opportunities that he's pursuing. Andrew, it's always great to see you. Thanks for joining me.
No, thanks very much for having me, Chris. Appreciate it.
There's a lot of debate right now, Andrew, about whether equities have run too hard and are we due an imminent pullback. Give me your sort of art versus science approach. So what data or forces are you looking at or keeping an eye on? And then obviously you've been doing this for a while. So, previous experience, how does that weigh into the picture?
It's a very complicated question to unpack, but where we're seeing today, the yield curve is pretty stable. Well, where we are on the 10-year and the yield curve, it's pretty stable at the moment, where Powell has sort of given indications of rate cuts and problems with the labour market, and then has sort of backtracked and said, hey, maybe rate cuts aren't coming as quickly. And what we've seen in the US is consumer stocks are breaking down dramatically, like massive underperformance of the restaurants and other consumer discretionary. So that's the negative. But then the positive is transport, which should be more forward looking than the consumer itself. Businesses need to get their stocking right for where the consumer is going to be. Transport's actually doing very well. So we're getting mixed messages. Also, if you have a look, the Russell is breaking out, US small caps, fantastic. Breadth coming to the market. Well, hang on, if you unpack that, biotechs are doing very well. AI is doing incredibly well. And the short basket, i.e. hedge funds who are short the market, are covering. And so that's doing well. But that's a lower quality. Themey multiple re-rate on AI, short cover, they're not necessary, and biotechs are not necessarily things that are giving me huge confidence in the market. And also, I think that retail's playing a big part of this. But then you look at that positive side when I talked about the yield curve is behaving. We're at a place where rates are high in the US, and we should rates are going to come down, have peaked, and there's sort of some. I think if the market keeps going like this, we will see that broader participation, and globally, stocks outside of those Mag 7, they are a lot cheaper than they historically have been as a whole. So it's a good spot, I think, for us stock pickers to be.
So Andrew, you touched on the yield curve there. Obviously that sounds like something you're watching very closely and paying attention to. Are there any other red lines? I mean, I know you don't look at things through a macro lens solely. Obviously you do a lot of high quality work, bottom up stock picking. But are there any other sort of red lines that you're paying attention to that you think, geez, if that went sideways or past the limit that I was worried about, you might think differently about the world that we're operating in?
Well, credit spreads are obviously something that we look, and you saw there were some wobbles with regional banks like Zion, like up the west coast of America, and some lending into property sector. Are there bigger issues there? And that sort of it peaked a little bit, but not to a when I say peaked, it went up a little bit, but not to levels that have previously been okay, all bets off, and has been sort of like subsequently in line. So we look at little things like that, but at the moment it's looking good. As I said, from looking at the underlying factors that are sort of driving the rally, they're not ones to get us like it's all on here. But the good news is that when people are starting to say, oh look, the market's expensive, you got to take out the subsectors that are there. That AI and all these things that are making it look expensive. And in Australia, obviously, there's other things, and and I'm hoping it's going to be a very big business in the future. But like Drone Shield and companies that need to prove the earnings, there's expectations building there. So Yeah, it's a very interesting. It feels like I'm saying this all the time, but it's a very interesting point in the market. But if this does really catch fire, this market, there's a lot of catch up from cyclicals, and so those companies that have been ignored, smaller companies, micros. There's a lot of catching up to do.
Andrew, let's change the angle slightly. So the Ophir team was recently recognised as the best Australian small companies manager. Congratulations at the 2025 Australian Fund Manager Awards.
That was good.
Typically, these awards get given when you have exceptional long-term performance, which is a given. But what else does the award highlight, or what would you like our audience to know a little bit more about Ophir and what goes on behind the scenes?
To be honest, I think, Chris, the way that award is given is who was the best performing small cap. I think who was the best performing small cap fund manager over the last 12 months. And I think that's a straight numerical. It's not a pay to play thing. It's like this is you. But I think maybe to your point, what I'd like to highlight of that is sometimes you'll see, I was talking to friends at Ausbil about it who have had a good year as well. And they won an award, and I was like, yeah, I know these awards, they can be the kiss of death though, right? And the reason you say that is because for someone like me, I'm like, well, what am I'm always looking for my blind spots, and we are always looking for our blind spots, and what's the factors that have led to that? How much of it was stock picking? How much of it was us taking risk or having some factor exposure that we're not aware of? And I think that's very important. And then to your point, I guess what I'm saying there is you'll see people win these sort of awards on 1 year, but then the next 2-3 years they're the worst performing funds. And we're obviously very cognizant not to do that. I'm a paranoid person. There's a great novel or a great book written about CEOs. Only the paranoid survive. I'm particularly paranoid. I think things are about to blow up every single day. That's hence you wanted me at the start, right, to say this great story about, hey, it's all small caps and we're on, and I'm telling you, like, consumers breaking down in the US, and that's how I think, because I'm looking for the problems rather than there's 100 people out there to tell you why to invest now because they want the people who are watching this money. I'm just giving you the honest thing. I'm trying to work out what goes wrong here. And so that's sort of how I think about it, and I think the way that the team thinks like that, and we're paranoid, that sets us up to continue to do well. And we'll have hiccups along the way, and we had a hiccup in 22, but it's the consistency and that paranoia of something's about to go wrong on either any of our companies or the market that sort of lets you to maintain that high level of performance. I think overall, just sorry to finish that, I think we've done 24.5% per annum return since we started in 2012 for the Australian Opportunities Fund, that small cap fund. And so now our investors have made about 18 times their money since they invested in 2012.
Andrew, just following up on this performance, we won't talk about it too long, but I did notice in one of your recent monthlies, you talked about batting average. Now, I've actually done quite a bit of work on batting average myself. I think it's one of the most underrated ways of assessing performance because it's tied in with consistency that you were just talking about. But obviously you made a point of mentioning it in your monthly. So can you just talk to us about the Ophir Fund's batting averages and why, again, it's important to you?
It's funny, I was going for a run with another fund manager. This is a couple of years ago, and I was talking about monthlies, and we're really focused on just beating the every month. And I just thought that was normal because when I used to work at Paradise, we were the same. And he was like, oh, it's really interesting. Maybe that's a reason why you've generated the performance you have, because you're always focused on that sort of shorter time frame. So putting that aside, what the batting average is looking at is like what percentage of months do you outperform, right? And so obviously you want a batting average above 50%. Babe Ruth, in what we wrote in that thing, he had he's the greatest ever slugger in the Major League Baseball, and he had a batting average of 0.3, right? So for us, our batting average looks like it's, I think, 0.6. One of the guys here tried to measure it. And that's what you need, and we don't get it right all the time, but you need to be outperforming in the majority of the months. It's funny, Chris, though, that it feels like every month that there's a stock that, when we're having a bad month, that there's a stock that saves us, and I guess that's the point of having a portfolio of 40 companies, you're getting lots of hits on target effectively, like every month. But yeah, that batting average is something that we're proud of. And then you have a look on an annual basis, and we've obviously done very well over the, what is it now, 13-year journey, in terms of we've outperformed the market in the vast majority of years. Because if you're outperforming in 8 out of 12 months, then the chances of you outperforming on a yearly basis get higher and higher.
Yeah, it just all stacks up. Andrew, you talked a little bit about stocks there, or started talking about stocks. So just for the audience's sake, I had the pleasure of hearing you talk about Life 360 and iRhythm at your Investor Day in Melbourne recently. So what struck me was the information that you had about these opportunities that I guess the average investor wouldn't. I don't mean insider information or anything sinister like that, but you were talking about adoption rates of the Life 360 app in various states in the US, and then how you could model what the earlier states look like, or the earlier adopting states versus the states that are a little bit behind. And then you had this magnificent breakdown of that and a few other elements, and how Life 360 gets to $1 billion in revenue. The other one that you spoke was about iRhythm, and you knew someone who was close to the company that you could, ask some questions of. Again, nothing sinister, no inside information, but I just wanted to...
They work for a competitor. So.
There you go, work for a competitor. So yeah, nothing untoward. But I just wanted to ask, because your stock picking is so good, how much of it is looking at the data, which, maybe a lot of people can see, or a lot of at least institutional level people can see, versus your level of understanding and insight about a particular stock or a sector, and then, other things that people don't have access to. So contacts and channel checks and things like that. Because, yeah, I'm sure there's different elements to go into what is, to be honest, great stock picking, right?
As you would as well, Chris, you go to some drinks or a barbecue, and people want to talk about stocks, and they're convinced that they're genius, they've got a daytime job, doing probably a lot smarter stuff than I'm doing, and they're convinced that they're geniuses because they made money out of let's just say it's Life 360. It's just a random company, and then you ask them, and they start talking about it, and they talk to you, and they realize they know nothing. And it's actually, well, hopefully they do. And it's actually, a lot of it's luck, right? Or, they've got onto one key sort of point. At the end of the day, we're doing this full time. I've got people here. I love hiring people that are smarter than me, who can, I work really hard. So if they can work as hard as me, that's fantastic, smarter than me. And we spend all our time just traveling around, speaking to competitors, customers, looking for data sets, all this sort of stuff, to put them all together, the mosaic together, to work out. And even then, we still only get it right 60% of the time, right? It's about the edge. And I speak to other fund managers, and you talk to them about stocks and why they own a stock, and it's quite interesting. Some people, funds that probably don't do as well, they have zero edge on a stock other than, I think it's a good company. Right. For us, we have to work something out that we don't think the market knows, or other fund managers know. So we'll always be talking to brokers and other fund managers and sort of sharing ideas, but also testing how much everyone else knows. Have people worked out, that the pet tracker for Life 360, that they're going to offer this. We're very confident that they're going to offer this off the app. So they're going to then be able to save 30%, which is how much iOS Apple charges. If anyone signs up to Life 360, they have to pay 30% to, but if you want to get a pet tracker for Life 360, the dog, around the collar, they'll give this off the app, which will save them 30%. Then we'll look at the analyst numbers, and we'll see that they haven't modeled anything for pet.
Right.
We work out they haven't modeled anything, and they don't understand the margin. No analyst understands that this is not going to be on the app. To get this great pet tracker, you have to sign up via the Life 360 website, what this means for margins. And that's just one little edge that we have now on Life 360. And I've just told everyone about it. The market the market will work it out pretty quickly because they've, within a day or so ago, they launched their pet tracker. So by the time people are seeing this, other people will have worked this out, that if you want it, you got to go to their website, and that means an extra 30% margin to their subscription. But it's just hard work. And I say this to you all the time, Chris, it's like, we're not special. Like, there's other guys in this business who are special. I'm certainly not. I just work really hard. I love what I'm doing, and it's the working hard and chasing down the edge and knowing that you're not better than anyone else, and it's only hard work that will differentiate you. That's what gets you those sort of edges.
Yeah, well, I can tell you love it, Andrew. That's why I like talking to you about this sort of stuff, because I love it too. All right, so give me the pitch now, Andrew, on one or two stocks maybe that we haven't heard you talk about yet. Is there something that you particularly like right now?
In Life 360, we had that as our number one position 18 months ago. We told the world we thought it could be a 10-bagger from here. And we've sold stock along the way. We bought stock last week because of this pet tracker launch. As it got launched, we were like, oh, this is looking really good. It's exactly what we want. We bought stock. So Life 360 is one we still like, and that there's a little bit of edge I told people about, and we think the pet tracker is not modelled by the market. So tick. Another one that I know you've had on, we actually told that, I think we said, what was it, in 2024 for the Financial Review asked us for their Christmas edition, what's our pick for 2024? And we said Catapult. It was trading at $1 back then, and it was a pretty easy story for us because we thought if it had to raise money, it was not going to be much at all, and everyone would jump over it. The market was worried it had to raise money, but it was growing at 20%, and you could see that the margins were going to grow to effectively be a 40% margin business. But that got us invested, but we went deeper and deeper and deeper as you build conviction. So when you get onto something, you work it out pretty easily. This is cheap, easy to own, but you keep doing work. So we don't stop doing work on a company once we own it, and you get to know it better and better. Yeah. So with Catapult, and I know you had Will Lopes on the did a great video for him. He's a fantastic CEO, by the way. We found a glaring problem with Catapult, and the problem is that in video, so they've got their wearables. We all know Catapult is that sports wearable technology with the GPS tracking, and they've got a huge amount of teams. Was it 3,000 teams going to 5,000, all that sort of stuff. And then they're launching all this smart video that's integrated with the wearable. And that's really exciting, right? Because now you got two products, the flywheel starts to get faster. The problem is the big competitor that's in soccer, football, is a company called Huddle. And what Huddle have is, and they did all the video, is they had this scouting product where if you wanted to get a player, you're able to look at the video and you could see the video of all the people in the second divisions and all this sort of stuff that you want to get. And so when Catapult were rocking up and saying, hey, we've got this great video, it's integrated with wearable, what Huddle was doing when let's say it's a Bundesliga soccer team, because this is how we found out about this, by the way. We were speaking of Bundesliga soccer.
Okay.
They said, look, Huddle are then coming back and they're saying, and this is like Microsoft bundling strategy. They're like, oh yeah, okay, you're moving to Catapult, that's cool. But you'll still need our scouting product because they don't have a scouting product. And then everyone's like, okay, yeah, so what's the price of the scouting product? And they're like, no, the scouting product price is 100% of the price of everything before. And so without a scouting product, Catapult was completely hamstrung.
Right.
And it's meant that we've had a lower weight for a long time, and we know the company well, and they know that we know this. It's meant we've had a lower weight for some time. Now, the great thing is they've just made an acquisition. It's a Bundesliga focused tagging scouting product. It's the best one out there. We've done all the work, and we've been asking people, is it for sale? And we didn't think it was for sale. We didn't know. and Catapult's just bought it. They paid a good price, like what was it, 70 million or 70 million? That might have been even euros. Anyway, they paid a lot for it to the naked eye, right? You look at it and be like, but the company, and I had a couple of people from the company who said, like, you guys were the first onto this. This has been a big problem for us. And this is the best acquisition this company's made. Like, it's just a phenomenal acquisition because they got such a great video product. They got such great wearables, but they were going to get blocked in the video if they couldn't solve this scouting. And they bought the next best scouting product that's out there. So this from us goes from a business that was growing at 20%, that was going to have real big problems being able to sell video and cross-sell it and hitting all their medium-term targets they had out there, to now a business that can accelerate and hopefully going 20, 21, 22, 23 and so on in terms of its growth. So to your question, how do we get this? Well, it's actually talking, it was not just Bundesliga, it was talking to EPL guys who are looking on the video from both of those and asking them about Catapult's video product. Have they heard about it? All those things. What do they think about Huddle? And they all identified the same problem.
Yep.
And it's now been solved, which is great because Catapult should be the category killer for professional sport technology, and they're showing they can make acquisitions now and become kingmakers of anyone who wants to sell into them of any tech product. So yeah, I like Catapult.
I have followed Catapult as well myself from quite early days because I've always been interested in sport as well. So I've seen that story grow, and I didn't even know what you were just talking about then with solving that problem, but I can see how that is a catalyst for that next stage of growth. So yeah, no, that's very cool. Andrew, last one for the day. This is my favorite question to ask, pure stock pickers like yourself, but what do you prefer more? So do you prefer the hunt for a new opportunity or the reward that comes when you get it right?
The best is neither of those. It's the kill when you've worked out an edge. You know what I mean? Like, so you're not getting rewarded in the share price now, but you've worked it out. Like, you've worked it out. Like when Life 360 launched advertising, and we worked out pretty quickly. We sort of done all the work beforehand. We knew how much advertising was, and we had the edge, and we knew the market wasn't there, and they're going to have to work it out. Doing that meeting where you work something out, and it gives you an edge on a company. That's the excitement, because that's what we're after. Going out there, doing the hard work, turning over rocks, and you do so much, and then every now and again you have that meeting, and it's the person who's the customer of the new product and is saying it's the best product they've ever seen, and you're like, wow, and this company trades on 4 times sales, it's going to trade on 10 times, and the growth's going to accelerate, and we're going to make this our biggest position. That's the exciting part. So it's not when the share price is going up.
Yep.
Because if it's going up at this stage, you're not first to the information.
Yep.
You're not the first one to work it out. And it's not the hunting, like the turning over rocks, because that can be really frustrating.
Yep.
It's the, it's when you turn over that rock and all of a sudden underneath it you see gold, effectively.
There's that little sliver that exists in the middle between the hard work and then when you get the reward. So, hey, I've asked this question many times, Andrew, and I have not had that answer before. So that's great. Thank you. And thanks for sitting down and having a chat. Like I said, it's always a pleasure. Great to get your insights. So I appreciate it.
Thanks very much for having me, Chris. Really appreciate it.
If you enjoyed that interview, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.